Notes Receivable. And so how we're going to deal with interest, and then also if a note is dishonored and how we deal with that. So a notes receivable is also sometimes referred to as a promissory note, and it's just a promise, a written promise, to pay a specified amount of money at a particular date in the future, and it typically has interest associated with it. So the maker of the note, or the debtor, is the entity that signs the note and promises to pay the required amount. And the payee of the note, or the creditor, is the entity to whom the maker promises future payment. And so you can remember that as thinking the creditor is the company that loans the money. And for this chapter, we are taking on the role of the creditor. So we're looking at what does it look like when we, as a company, loan money out to other people and they pay us interest and that money back in a future date. In different chapters, we look at notes payable, where we're the ones paying out the interest and the return of the capital. But in this chapter, we're always the creditor, or the person issuing the money out. So there's some kind of just keywords that we have to know as far as dealing with the notes receivable. One of those words is principal, so that's the amount loaned by the payee and borrowed by the maker of the note, so that's the amount exchanged or loaned. Interest is the revenue that's earned for loaning that money, and so in this chapter it's going to be a revenue to us as the creditor, and it'll be an expense to the debtor. The interest period is the amount of time during which interest will be computed. So it goes from the original date of the note to the maturity date, and sometimes it's referred to as a note term. The interest rate is the percentage rate of interest that is specified on the note, and so it's almost always stated for a period of 1 year, and is how we'll calculate the interest revenue. The maturity date is the day when the final payment of the note is due, sometimes referred to as the due date. And maturity value is just the sum of the principal plus the interest due at maturity. And so the maturity value is the total amount that will be paid back. So of course the person borrowing the funds will pay back the total principal plus all the interest, and those things together give us the maturity value. And so you can just see this example of what a promissory note looks like, where it shows the amount, or the principal, the date being when it was issued, and so that's the starting date for the interest period. The payee is listed. The principal, you can see further down, is written out kind of like a check, and then the interest period end date is listed, and the interest rate is also listed as well, and then finally the maker of the note. So as far as the journal entry goes, again, remember that we're the company issuing notes to a borrower. And so what that looks like is a debit to Notes Receivable, Holland. So again, we're using that subsidiary ledger to identify specific clients, I guess you could say. And a credit to cash. So that's decreasing our cash because we're giving it to somebody else. We're increasing the asset of a Notes Receivable because we are going to get that back in the future. So then as far as identifying the maturity date, some of them will actually have the maturity date specified, like we saw in the previous sample. Other ones, instead of specifying a date, will provide a number of days or months. So if the period is given in months, then the maturity date falls on the same day of the month as the date the note was issued. So if it is June 12th that was issued, and then it's a 6-month note, it'll be December 12th. If the period is given in days, the maturity date is determined by counting the actual day from the date of the issue. And so when you're doing that, you do include the maturity date, but you do not include or you omit the issue date. And so that works out when you use Excel to count the days for you. And so this slide just shows us a 6-month note dated February 16th, 2025 that matures on August 15th. And so it just gives us the breakdown where we have 12 days because it was February 16th. There's 12 days remaining in February, and then it breaks down the months, the number of days in the months in between, to get us to a cumulative total of 180 days, or the 6 months. As far as computing interest on a note, we actually did look at this in Chapter 3 when we were doing adjusting entries, but we'll cover it again. So the formula for calculating interest is the principal times the interest rate times time. And time represents the portion of a year that the interest is accrued on the note. So we can do that as a fraction of months or days, as we did in that previous chapter when we've done this before. So if it was a full year, then you can see this example where we're saying $1,000 principal times 6% interest times 1, or 12 out of 12, gives us a $60 total interest. So we could then calculate the maturity value of this note by saying $1,000 principal plus $60 interest must be returned to us for a total value of $1,060. However, when it's not a full year, then we have to account for that. So in this example, we have $2,000 note, 10% interest for 9 months. And so it would be principal times rate times time, or 2,000 times 10% times 9 out of 12, or of course 3/4, and that gives us $150. If it was a 60-day note, we could do principal times time times 60 divided by 365, and we get 98.63 in this example on the bottom of the screen. And so, just quickly, I'm going to open up Excel. We'll use the 5,000, 12, and 60. And so, I just wanted to bring it up in Excel because Excel can calculate it so easily. And so you might want to just create a workbook that has a setup where you can just change the inputs. And so when I set up a template like that, I change the inputs to like a blue sort of color so I know that these are the things that I should change to calculate for me. Let's put time here. And so in the example, we had 5,000, 12%, and 60 days. So principal would be 5,000, 12%, we don't 2% signs. And then for the time, the only thing you might want to like make a note to yourself is are you going to do months or days, or be aware so that you can change it. So in this case it was days, so we'll say equals 60 divided by 365, and then we can have the calculation, so we can just tell Excel equals principal times rate times time. We don't want a date, we want a number. And so we get 98.63, which is what was calculated in the slides as well. Let's do the 2010 and 9 months. So then we could just change this and say 2,000, 10%, keep doing double percentages here, and 9 out of 12 months, and we get $150. And so just the point being, it's really quick and simple, and you can set up an Excel sheet that already has the calculation here and just change your inputs and it'll spit it out for you every time. Okay, So back to our presentation here. We have this example where we lent Lauren Holland $1,000 on September 30th for 1 year at an annual interest rate of 6%. On December 31st, we need to accrue interest. And so let's jump back really quickly. On September 30th, we had a debit to notes receivable and a credit to cash. So that was our initial when we lent her the money. Now we're saying it's December 31st, and we need to account for the interest that we've already earned, but we have not yet received. And so let's jump into Excel. We'll put 1,000, 6%, and as far as time, it was from September, let's check if it was the 1st or the 30th. The 30th. So we have the whole month of October, November, and December, so we can say equals 3 out of 12 months, and we get 15, which is also what is displayed here on this slide. And so on our adjusting entry, it's going to be a debit to interest receivable and a credit to interest revenue, which is increasing the asset of interest receivable, and increasing the revenue of interest revenue. So both of those two things are increasing on December 31st. But we've not received the cash yet. So cash isn't involved. As we said in previous chapters, cash will never be involved with the adjusting entry, just this receivable and the revenue. And so then how do we see what happened here? And so they're just providing this timeline that on the 30th the note was issued. Then as of the 31st we did the adjusting entry to accrue the revenue. So that was $15. Then from December 31st to September 30th when the maturity date is, another $45 of interest will be earned, or 9 out of 12 months. And if we jump back to our Excel sheet, we can quickly change this to 9 out of 12 months for that same 45. So then, when the note matures and we receive the money back, it's going to be a compound entry that's going to do a couple of different things. Of course, we're going to receive the cash for the maturity value. So that's the principal plus the interest associated with it. Then we also have to eliminate the notes receivable asset because they're now paying it off and we no longer can receive it because we're receiving it today. So that has to be eliminated for the original amount or the principal amount. Then we also need to eliminate the interest receivable from our December 31st adjusting entry because today we are receiving that money. And then finally, we have to record the revenue of the interest that we did earn from January 1st through September 30th. So you can see that all of those together, all of our credits summed together total are a single debit of $1,060. So here's another example. On July 1st, 2025, Rosa Electric sells appliances for $2,000 to Dorman Builders in exchange for a 9-month, 10% promissory note. So on July 1st, you can see that we've debited notes receivable and credited sales revenue for the $2,000. Then on December 31st, there is an adjusting entry to account for the interest receivable or the asset that we're going to receive in the future, as well as the revenue that we've earned from July to December for $100. Then on April 1st at maturity, you can see that we received the cash by debiting it for the maturity value, the principal plus all the interest. We've eliminated the notes receivable by crediting notes receivable. We're eliminating interest receivable with a credit, and then we're increasing the interest revenue for the interest we earned from January 1st to April 1st with this credit to interest revenue. Here's one more example. Very similar, or no, sorry, it's not similar, because now Oh, it is similar. I should just read the description. Sports club cannot pay Blanding Services the amount due on their accounts receivable of $5,000. Blanding accepts a 60-day $5,000 note receivable with 12% interest on November 19th, 2025. So in this case, instead of our company giving cash, we're just converting an accounts receivable over to a notes receivable. So you see the first entry is a debit to notes receivable, increasing that asset, and then a credit to accounts receivable, decreasing that asset. So we're really just exchanging one asset for the other. Then on December 31st, we have accrued interest, and so a debit to interest receivable, credit to interest revenue, and let's go check these days. So in Excel, let's put November 19th and type December 31st. And so let me actually go the other direction. So in Excel, if we just say December 31st minus November 19th, we get the same 42 days that they used to calculate interest receivable. So we could say 5,000 and it was 12% interest, and then we can say 42 divided by 365 for $69.04, which they rounded to 69. Then January 18th, they received the cash payment for the principal plus the interest, or the maturity value. They're eliminating the notes receivable, eliminating interest receivable, and increasing interest revenue for the revenue earned from January 1st to January 18th. Okay, so now we'll look at dishonoring notes. And that, when that happens, so it's similar to an uncollectible, but at maturity, the person that we've lent money to decides or doesn't pay it. And so that means that the note has been dishonored. And when that happens, the amount of the note, the principal, plus the interest is transferred to an accounts receivable. So then the accounts receivable will be, the company will attempt to collect on the accounts receivable and might end up getting written off in future periods. So in this example, we have Rubenstein Jewelers has a 6-month 10% note receivable for $1,200 from Mark Adar that was signed on March 3rd, 2025, and Adair defaults. Rubenstein Jewelers will record the default on September 3rd as follows. So an increase to accounts receivable by debiting it, and then we're eliminating the notes receivable for the principal amount, the $1,200, with a credit to notes receivable, and we're also showing the interest revenue, increasing the revenue account by crediting it for the interest that was earned on this account. And that finishes up our discussion on notes.